Good afternoon, ladies and gentlemen. This is Deb Strong at Financial Brokerage. I want to say thank you to everyone on this call today on behalf of myself and Keith Candido here at Financial Brokerage. We really appreciate your time today and just want to start out with just a couple of housekeeping items. And that is the first thing that we're going to talk about would be our incentive trips this year. And I'm really excited to say that we've got a couple great trips. One is to Hilton Head Island in South Carolina. That requires 70,000 points for paid annualized life, or 35,000 of annualized life for that trip, 875,000 of annuity premium. And the second trip is to Prague in the Czech Republic, which will be a fabulous trip, and that one requires 1.750 of premium or 70,000 shared success points. So we hope to see as many of you as we can on these trips. I think they'll both be phenomenal. So we're excited to announce that. And then the second thing I wanted to touch on is I hope that you guys are aware of an agent referral program we have, and I like to refer to it as an agent's deferred comp plan, whereby if you refer another agent to us and they write any line of our product, whether it's life insurance, long-term care, DI, med sups, annuities, you continue to get a bonus off their production for 10 years, which is huge. So be sure and ask Keith and I how to qualify for that. It's very easy. You get on our website, click a button, and you are in it. You don't have to keep track of what these referrals do. We keep track of all of that for you. So please be sure and ask us about it because it's a wonderful program to participate in. So without further ado, I'm going to pass it over to our friend Mackenzie Swenson from Equitrust. And Mackenzie, thank you so much. We really appreciate it.
Yeah, absolutely. Thanks for having me, Deb. It's a pleasure to be here and share a little bit more about Equitrust and some exciting opportunities that we have. I do want to spend some time talking about our recent product consolidation, some great opportunities with our big bonus products, some accumulation opportunities, and then just some ways that we keep doing business with Equitrust simple and easy. But before I jump into that, I did want to mention the passing of the Secure Act and kind of the impacts that it has. Well, we don't have all the details because it did come up rather abruptly near the end of 2019 and went into effect 11 days after it was signed into law. So beginning January 1st of this year, it was signed into law and became effective as part of the federal government spending package. So Secure Act stands for Setting Every Community Up for Retirement Enhancement, and it's intended to strengthen retirement security. So big changes that will be impacting Equitrust anyway, while there are a few others, inherited IRAs and stretch IRA changes. So in general, the changes there are is they've got to liquidate those funds within 10 years. So instead of being able to stretch those inherited IRA RMDs out over their lifetime, they're now limited to 10 years. And then RMD age has been pushed up to age 72 instead of 70 and a half. And then contribution limits has now allowed for contributions past the age of 70 and a half. There will be more details to come. I know there are some other changes that have happened, but these are really kind of the ones that we feel impact Equitrust and how we do business. I know there's a lot of carriers out there that are kind of in the same boat as us, getting their arms around what the impacts of the Secure Act are, and all are putting out announcements. So a lot of good information out there. But that's kind of just a little bit on that. Now I want to go ahead and jump into our indexed annuity product portfolio and kind of what we did last year. It's been about a year now. We took a look at our indexed annuity portfolio, and at that time we had 9 indexed annuities. A lot of them had very similar features with some few differences, a lot of commonalities. We then took a look at our state availability, and we saw a lot of gaps. We saw a lot of states that we did not have products approved in. And then we also looked at the industry as a whole. There was over 100 new indexed annuities introduced in 2018. And we looked at that and we thought, wow, that's a lot for any marketer, any advisor, any agent to get their arms around and try and understand. So we thought, you know what, here at Equitrust, we like the simple approach. Let's look at our portfolio. Let's take those 9 indexed annuities and let's kind of consolidate them down to 4 indexed annuities. So we combined a lot of the ones that had similar features and product details, and then we refiled with the states and we really opened up our state availability. So these are the 4 left standing here. The 2 on the left are going to be our 2 bonus products, so MarketPower and MarketTen. MarketPower is our #1 selling product. It's got a 10% bonus. On the next slide, I will go into that on a little more detail. MarketTen bonus is approved in every state but New York. That has a $10,000 minimum for non-qualified, but a $5,000 minimum for qualified. And then it's got a 6% bonus on all deposits during the first 5 years. So it's a flex premium. We see a lot of IRAs being opened. We see a lot of consolidation of different assets with this product and taking advantage of that bonus. And then the other unique feature of MarketTen is it's got a no-cost return of premium rider. So day one, the client has that peace of mind that at any time something should come up, whatever the reason may be, they can submit for a full surrender of their contract and never get anything less back than the premium that they put into the contract. And that's all deposits. Another thing I'll mention with that, you'll see a lot of annuities that when you're making multiple deposits, they kind of have rolling surrenders on different pieces of money. With this, doesn't matter how many times or at what point you add to that MarketTen, it's always going to maintain the original issue date that the surrender charge schedule will be based on. So just a nice little tidbit there. The 2 products on the right are going to be kind of our accumulation workhorse products. So strictly accumulation focused. I know Deb and I were speaking before we started the webinar here, and we've really kind of seen a shift in the industry as a whole. Income rider election rates are down, and there really has kind of been more of a focus on that accumulation side. And these are definitely 2 great products to look at to fit into your accumulation product portfolio. So MarketValue Index, that product's been around for many, many years. It's a 10-year surrender. It's got great account options and great rates offered with it. Today, I would say this is probably our #2 selling product, right behind our MarketPower. And then below that, our MarketSeven Index. That product is very similar to our MarketValue. Big difference is it's going to be on a 7-year surrender. And then the cap rates are going to be slightly less just because it's a shorter surrender schedule than what you would see on the MarketValue. But same different account options, so greater shorter term accumulation focused product. Both of these products are also approved in every state but New York. So MarketTen, MarketValue, and MarketSeven, we were able to get approval in every state that we do business in. But now I want to jump back and kind of talk a little bit more about our #1 selling fixed indexed annuity, our MarketPower bonus. So this has been our #1 selling fixed indexed annuity. This product's been around since 2004. It was our top seller every year but one. And really, how many products do you know of that have been available in the market for that many years that are still around and still top performing? There just really isn't a lot of them. And this is just kind of one of those ways that Equitrust has chosen to keep with that simple model and that simple theme. We're not a company that's going to be changing things and coming out with products and, flipping over the shelf continuously. We do like to be innovative and embrace the technology and the changes, but we like to still keep it simple. What is going to be the most effective for the client? What's easy to sell? What's competitive still? Client-friendly products. And as I mentioned on the previous slide, this product has a 10% bonus. That is a day one bonus. It's part of that accumulation value. It's part of that death benefit. And the large bonus on this product, it's unique, and it has its place for a few different reasons that I can think of. But first, I want to talk about the state availability and the opportunities there with this product. So we don't have approval for this product in New York. We don't do any business in New York. And then there's 2 other states, that we did not get this product approved in due to the large bonus. So it's California and Delaware. All the other states we have approval in. So in the teal states you see here, this product is going to be a 14-year surrender schedule. So generally a larger bonus product is going to have a longer term surrender schedule. So 14-year surrender schedule in around 30 states. And then in these kind of lime green states you see here, it's going to be a 10-year surrender schedule. So about 15 different states. So depending on what states you do business in, I know we have a lot of producers and advisors out there that do business in multiple states. It's going to be a 10-year surrender schedule while still offering that full 10% bonus, which is credited day one to the client's death benefit and accumulation value. So no change on the bonus, just merely a reduction in that surrender charge schedule. So I know these lime green states are states that definitely, insurance companies have a harder time getting large bonus products approved there. So definitely a niche for Equitrust. Now I mentioned, there is a time and a place, and when does a bonus make sense? A lot of times with a big bonus product, you're giving up something in terms of cap rates and participation rates that you see on the indexed account options, which is definitely true. We're offering a much higher rate on our accumulation focused products, but there are opportunities for a big bonus product. And here's just a couple that I have come up with. So the first one being offsetting previous investment loss. Maybe the client is coming out of an underperforming product or needing to recover from some market loss. This is a way to immediately give them that 10% bump day one. Maybe they're looking for an income bridge to Social Security. You have a client, that's trying to fulfill that income gap. That 10% bonus, like I mentioned, is part of that accumulation value day one. Well, it's also part of that 10% penalty-free withdrawal the client has access to each year after the first year. Another reason would be for wealth transfer. What's that client's time horizon? Now, no one, can forecast the future, but if they're looking at transferring wealth within the next 7 to 9 years, a large bonus could really impact the value and what is passed on, to a beneficiary. We recently kind of ran the numbers and looked based on a 10-year look back, the best performing and the worst performing 10 years scenarios. How many years does it take for a non-bonus annuity, just a purely accumulation annuity, to pass a product like the MarketPower? So we did the comparison, and anywhere between 7 and 9 years it took for the non-bonus annuity. 7 years being, the better performing years, and then, more around the 9-year range for the worst period, the worst 10-year period. So definitely some time there, and something to consider, if you've got somebody that's needing access to the money or the death benefit within, those first 9 years. So definitely a great consideration there. Now, I did want to mention with the product consolidation and restructure, another thing, I know I mentioned income benefit riders election have kind of been down. Well, there still is a place for them. And we kind of have a niche with our income rider that I'm going to touch on here in a couple slides. But with the product consolidation, we did change up our income riders, and we made an income rider specific to each product. With that, if you elect the income rider on one of the products, you're going to get a different cap and participation rate than if you do not elect the income rider. I think we're a little unique and different in that we do that. So what that has allowed us to do is to price the cap rates differently. So pricing from adding an income rider standpoint to pricing the rates if an income rider is not elected. So that is one of the differences. But here's kind of a snapshot of the income riders we offer we've got this great one-page marketing flyer. Makes it really handy and easy without having to go out to the software and try to quote all of the different products and all of the different income riders to see when the income is going to be better for one versus the other. We've created kind of this little guide for you in essence. So under that profile section there, you can see like MarketPower, we've got stronger guaranteed income in the early years. If you've got somebody that's looking to turn on income in those first few years. If you've got somebody that's looking for that non-guaranteed income, likes that opportunity for growth with market value with an accumulation product, but also wants that income rider. This is going to have strong non-guaranteed income because the income rider is a stackable design. So we've got this great piece on it. But really what I want to focus on is where we're competitive and what the feature is that's competitive with our income rider. And that really comes to that doubler portion, so that enhanced income withdrawal payment. So payments can be doubled for up to 5 years for chronic illness. No confinement required with our doubler. So I know that's kind of unique. It's just 2 of the 6 ADLs is the trigger. But it also applies to extreme permanent cognitive impairment. It's not an and, it's an or. So one or the other would be a way to trigger that doubler. And then the withdrawals will continue even if that accumulation value is depleted and goes to zero. So as long as there's at least $1 in that accumulation value at the time they trigger that doubler, we're going to double for the full 5 years, for up to that full 5 years. A lot of the doublers out there, once that accumulation value is exhausted, the doubling stops and ceases. So ours is a little unique in that aspect. It is approved in all states. So any state that your product's approved in, that doubler is available as well. So I know California is one. I know I've heard from other producers that we stand out and we have our doubler approved there. Although we don't have our MarketPower, we've got our MarketTen, MarketValue, and MarketSeven products with the doubler in California for any of you that might do business there. And then another unique feature of our income rider is upon spousal continuation of lifetime payments with a single payout, income is recalculated and continues on for the life of the surviving spouse, even if the accumulation value is depleted. So essentially, we would do a lifetime payment for either or of their lives, assuming there is money left in the accumulation value upon death of the first spouse. So that is a unique feature as well. And then how we calculate our income rider fee. You know, sometimes you look at the number and you say, gosh, that fee looks kind of high. Well, in comparison to many of the other competitors of ours, we calculate our annual fee based on the accumulation value, not that much larger, faster growing benefit base. So the fee is calculated on and charged out of the accumulation value. So another unique feature there. So that kind of sums up our income riders. And now I kind of want to shift our focus over to our accumulation products. So our MarketPower, or excuse me, our MarketValue and our MarketSeven. I did mention those are a 10 and a 7-year product. They have a $10,000 minimum. They're flexible premium products. And then I also mentioned they have a number of different account options available. So here you've kind of got your tried and true several S&P based accounts. So all of them except the bottom 2 are going to be based on the S&P 500. So just kind of long-standing go-to account options based on, you know, the S&P, which has been around forever. A couple I wanted to kind of point out that we've seen not only a lot of activity in, but a lot of success in as well over the last few years. First being the 1-year point-to-point participation. That's got a 40% participation rate currently. So no cap on the upside, and that 40% is approved in every state. So no changes there. That one's been very popular. We've had it around for, I want to say close to 2 years now. Renewal rates we've seen been strong on that account option as well. All of them for that strategy have renewed at what they've been issued at or higher with what we've experienced so far for renewals. The other one I want to point out, which I think is a little more overlooked, is a 2-year monthly average cap. 16% cap. So, if you look at it, if they capped out, that would be 8% per year. Not too bad in a fixed indexed annuity. So great opportunity there. Also great to consider a monthly average with a point-to-point and the opportunity of diversification. Where a point-to-point could maybe fall short, a monthly average could really carry you. If there's a dip right at the end of the contract, a point-to-point isn't going to perform at all. With a monthly average, it takes an average S&P value of all 12 months. So that can definitely carry you in some more volatile markets. So something to consider as well. So you see all these different account options here. I want to talk a little bit more about diversification and some information we gathered. So we took a look at our market value index and the importance of why you shouldn't put all your eggs in one strategy basket. So this has not been updated to reflect 2019. That is in the works. So new information should be available. So it'll be awesome to see what adding another year to this chart will look like. So we looked at all of our one-year account options and the percentage change in their performance from year to year based on a 1/1 date from 2008 through 2018. So here, just showing that the pure change in the S&P. So then we ranked all of those one-year account options from top to bottom with the highest performing to the least performing every year. And here's kind of what we experienced. So honestly, I think we were all kind of a little shocked to see this. There's really not a lot of consistency among the chart. It's very patchwork looking. So if you look at that top row right below that S&P number, those are your top performers each year. So not a lot of consistency year over year. Another reason, you should definitely be considering diversification. What performed well last year isn't necessarily going to be what performs well the next year. Now, I will gray out 2015. I will say the S&P was down. 2015 was a year that none of the account options showed any credits. It was all zero for 2015. But besides that, there were only 1 year that back-to-back the same account option credited was the top performer in 2009 and then again in 2010, so 2 years in a row. As you can see there in kind of that lime green color, so that point-to-point participation with the 40% participation that I mentioned. Something else that kind of stood out was in 3 of the 4 years that the S&P was either a negative change or a zero or flat, either a monthly averaging or a multi-asset risk-controlled strategy performed and showed a return. So again, another reason to look at a monthly average account option or look at diversifying some to the S&P and some to like a multi-asset strategy. So very interesting there to see. So this chart we do have available as a one-page flyer to kind of show your producers, office staff, marketers, for agents to use with clients. It is available on our agent website. It will be updated, like I said, in the next couple of weeks to reflect the 2019 edition of values as well. But very strong information. And it was honestly kind of eye-opening. A lot of people have kind of hung their hat on over the years, annual point-to-point, that's kind of been the top performer year over year more consistently than others. And it's interesting to see that that's not always the case. So with the discussion of rates and talking about rates, Equitrust is very proud of our renewal rate history and our renewal rate integrity. So I do want to spend a moment kind of sharing an example, again, on our market value, our accumulation workhorse product, and how we price things and what our integrity and value is with our renewal rates. So we've got a strong track record of our renewal rate history. So looking at a contract that was issued February 1st, 2008, looking at that annual point-to-point cap, it was issued at 6.25. It stayed at 6.25 for 4 years. Then it actually went up for 4 years, and then did see some slight reductions in 2016, 2017, 18, and 19, ending at 5% this last year. So very strong renewal rate history, 5%. That's still better than what we're offering today on an annual point-to-point cap for this product. So we hold them when we can, we raise them when we can, and we lower them when we absolutely have to. So we are very transparent with our renewal rates is another thing I want to mention. You can go out to our agent website at any time, go to the interest rate tab, click on renewal rates, and for any product we've ever issued, any issue date, you can go out there and plug in as many issue dates as you want, and you can see the complete renewal rate history of every contract we have ever sold here at Equitrust. So very transparent there, very proud of our renewal rate history and integrity. Our rates and caps are fully priced, so we never subsidize any rates, which allows us to maintain the strong renewal rate history and philosophy. So that kind of wraps up everything that I wanted to talk about here today. A few things I do want to mention at the end here. I just kind of want to wrap it up. And then I am going to spend a moment talking about our SPEA and then suitability. Deb asked that I touch on our suitability. Is, that's something that does vary widely by carrier. So I'll spend a couple moments on that as well. But first, just keeping in mind, Equitrust, we're simple in how we do business. Last year we consolidated our indexed annuity portfolio, going nine products down to 4, and we opened up that state availability for these 4 products and that chronic illness doubler. We've got that strong bonus product, MarketPower, our #1 seller with a true 10% premium bonus. MarketValue, that ultimate accumulation product, offering tried and true account options, linked to that S&P. And then hanging our hat on that renewal rate integrity that we're proud to share and very transparent with. So no login required to view any of those renewal rates. And ones that you'll be happy to share with your client over the years of that contract when it comes to annual review time. Okay, so with that, I'll mention our SPEA first. We do have a couple fixed annuities and then a single premium immediate annuity as well. Our SPEA, we offer a great commission on that. So it's a flat commission at street level, 3%. Doesn't matter the client age, doesn't matter the payout type. And then in addition to that, we are very competitive on our payout rates for a lot of the different payout options, whether it be a life or a fixed period. I would definitely encourage you when you're shopping for a SPEA to take a look at Equitrust for those rates. And then a few tidbits on our suitability. Our suitability review process, I'd say, is a little more hands-on, and it's a little more, we haven't boxed ourselves into a whole lot of guidelines like a lot of carriers have. So we've kind of got a few hard rules that we kind of live by, and those would be the 3-year replacement rule. So if you're replacing another product, it's got to be enforced for a minimum of 3 years. Another would be the client cannot have a reverse mortgage. That's an auto decline as well. And then as far as replacing, surrender charge percentage, you get up into that 10 to 12%, that's kind of going to be another area where it's going to be more unsuitable. But outside of that, we're going to kind of look at the whole picture. We're going to look at, where the client is now, what they're moving to, how this benefits them, and how it aligns with their financial goals that they have. And then also, from an income and expense and liquid asset standpoint, Does their income exceed their expenses? You know, are they financially in a good spot there? Do they have some sort of liquid assets? We don't have a set percentage. You know, some carriers might say you need 50% liquid to what you're going to be putting in. We don't have a percentage on that, but you know, they've got to have a nest egg. They've got to have, you know, that emergency fund set aside. So there's no real hard percentage on what they need there. Outside of that, you know, we kind of consider a lot of stuff. So we don't have like a form you can fill out or any pre-suitability, but I would encourage you, you know, if you have any questions on suitability, our sales desk is very versed in kind of some pre-suitability review, and that they can kind of tell you if they see any red flags on anything. They see all of the declines that come through on a daily basis, so they kind of know what we're approving, what we're not approving. You know, they can't tell you absolutely, yes, we're going to approve this, but they can tell you if they see any concerns with the information that you're providing. So kind of liberal there, which is nice. It definitely gives us the opportunity to look at some other stuff that maybe some others cannot. But that's all I had today, so thank you all for joining, and I'll go ahead and turn it back over to Deb.
Thank you, Mackenzie. I appreciate it. You know, I wanted to close with a couple closing statements, and that is, for any carrier, for any insurance agent to stay in this business, you really need a solid foundation. And to me, Equitrust comes through with shining stars on their good renewal rates. And that's the bottom line, is what are our clients going to get for renewal rates? So please keep that in mind when you're thinking of writing a case with us, with Equitrust. You know, the old saying, less is more. I love how you streamlined your menu to narrow it down to these 4 products, because they're all unique in their own ways. The bonuses being a true bonus vested day one, competitive compensation, lifetime payouts for joint couples, which is huge, and above all, the suitability, because to me, Equitrust stands out in the suitability area because they're very easy to work with and very fair with their suitability guidelines. So I would urge all of you on the call today to please reach out to Keith and I for your next case. We would love to help you with your annuity sales. And Mackenzie, thank you so much for your time today. Equitrust is one of our favorite business partners, and I want to thank everybody for being on the call today. Call us soon. Thank you. Okay. Okay, I'll call him individually because the Secure Act, they aren't doing inherited IRAs right now, so I'll reach out to him. Can I take it off speaker or should I let you connect it?